But anyway, so I am thrilled to give this presentation. This is actually my first virtual presentation. I've been attending an awful lot of Zoom meetings and participated in Zoom meetings, but have not actually presented, although I have a fairly lengthy experience with online teaching. I was an adjunct professor at Cal State East Bay for 10 years, and I would say 80% of my classes were taught online. So this is not necessarily new technology to me, but it's also always a little wonky when you're a little rusty. I need to actually shout out to two organizations. One is Kirscher Miller is a CPA firm back in Philadelphia. I had attended a CFMA webinar Zoom meeting on this topic a couple of weeks ago, and it was absolutely fantastic. I knew I was going to be giving this presentation, and there were some very interesting slides that that Mario Vicari of that firm had presented. And so I wanted to do the right thing and say, Mario, great presentation. Do you mind if I borrow some of your slides? And he was actually very gracious and said, yes, absolutely, go ahead. So I do want to give acknowledgement to that, and I've certainly highlighted those slides that I think are appropriate. And so please just bear in mind that if you know, these slides can be available to you, but just respect the fact that they are copyrighted. Quick little disclaimer here is that, you know, as we mentioned, all these rules are in a state of flux. We've had, I think, our first round of regulations that have come out, but there's more to come. And then, of course, Treasury is still dealing with the tax consequences of this, and I'll talk about that when we get towards the end of the presentation. So here's an interesting slide. I jumped on the website a couple of days ago to see if there was anything updated on this. Kevin, maybe you have some additional information, but this is interesting information that the SBA does publish, and I believe will continue to publish while we're going through this pandemic. I'm trying to make this go away. How do I make my videos are blocking my slides. Anyway, so you can see that the $342 billion with a B went out as of April, and we know that there was a second round, I believe, that came after that. So we'll see more statistics on this, and you can see that each lender on average is looking to process probably almost 5,000 on average of loans. So they're going to be very busy. They were busy with the applications. They're going to be much more busy with the loan forgiveness process, which, by the way, you will be required to go through your lender in order to get the forgiveness. Interesting statistic here. So the average loan size is about $200,000. They have ranged all the way up to, well, have that statistic, but the point is, oh, yeah, over 5 million. You probably heard some rumblings of, well, as Kevin and I were discussing this, you might want to seek if you received a PPP loan, you might want to seek the advice of your attorney and or your spiritual advisor. Because there might be some soul searching that goes through on this. Did you really need the money? And prior to, I guess, Friday of last week, there was no dollar threshold. It was really up to you to say, well, gee, do I really need the money? And can I prove that I was in need? Well, they came out with a threshold that said for $2 million loans or less, you don't have to worry about it. The assumption is that you were in need. But if you're over 2 million, you might want to consider giving the money back if you can't prove a hardship. So the outline for this presentation, and again, this is not necessarily a webinar of such, it's more of a Zoom meeting. So as Shane said, you can chat in your questions. I would go ahead, Shane, and just as things are chatted in and there are maybe specific questions regarding the topic that I am on at the present, you could go ahead and interrupt me and say, hey, Tim, I got a question on that, rather than waiting till the end. If, however, it's a question that maybe was already answered, or I'm so far off the topic now that we would get back off track, then let's wait till the end on that. But go ahead and feel free to answer some questions contemporaneous, or ask some questions contemporaneous with the presentation, if it makes sense. So we're going to talk about the timeline of loan forgiveness. We're going to talk about some definitions and some tests. I'm going to go over some case studies, which again, I want to credit Mario and his firm back east for putting together, because I think that will actually illustrate very well why not a lot of people are going to get 100% forgiven on these loans. And then we're going to talk about some planning, maybe some best practices that can help you, actually report to your bank on forgiveness and to maximize that. And then, because I'm a tax guy, I do want to talk about some of the interesting tax aspects of this, which are right now unsettled. Okay, so here is one interesting slide. So we've started the clock. Once you have received the loan, the clock starts for an 8-week period called the covered period. Again, regulations came out over the weekend, however, that said that you might have a choice. And the choice is the date from which the loan proceeds were received, or your next payroll period, if that date somehow is askew from your payroll period. The reason they did that is that people were receiving the loan proceeds, then using them to pay payroll, and then confused as to how that amount was going to be designated to be a qualified expenditure for purposes of the 8-week period. I think the other thing that was going on there was that prior to receiving the loan proceeds, employers were actually taking exemptions or deferrals on their payroll tax, getting credits for payroll taxes and participating in the deferrals. So in order to allow a clean cutoff of this, because by the way, if you applied for and received the PPP loan, you don't get the credit with respect to the payroll taxes or the deferral with respect to payroll taxes. So that's considered by them to be a double dip. So that's the reason for that. But generally speaking, a 6-week period, you must spend the money by June 30th. So in other words, if you still have money left over by June 30, you don't have the opportunity to get forgiven because you didn't spend the money. Again, a clarification that came out, I think over the weekend, was what does paid or incurred mean? I think that some of us were, especially the accountants, were saying, well, if I'm on an accrual basis method of accounting, I have incurred an expense, I haven't necessarily paid for it. Does that count? Versus a cash basis taxpayer who gets the deduction when they make the payment. So I think that there was some clarification on that in fact it is incurred during, which means would be accrued during the recovered period, the covered period, such that if the expenditure was made after June 30th, but was incurred during the 8-week period, I believe it would qualify. But again, that's might want to defer to Kevin on that if I've said something incorrectly. Once the June 30 date occurs, we then have a loan forgiveness application period. So, I mean, you'll have to apply for, through your bank, and complete an application for loan forgiveness. And we'll go over some of the details on that. And I'm just talking about the timeline here. The bank is required at this point to respond to the loan forgiveness within 60 days. Now, I think it's going to be difficult, as you saw in that previous slide. The average bank processed almost 5,000 applications for PPPs. That means that they're going to have at least 5,000 of the loan forgiveness applications that they're going to have to respond to within 60 days. We know how efficient they were, on the application side for getting the PPP loan. I wonder how efficient they're going to be on the loan forgiveness piece, but we'll just have to wait and see. No reason, however, to wait until June 30th to start collecting your data, all right? And we'll go over some best practices in that. So then, and then at the end of this timeline out here, the end of the 6-month period, that basically just says, to the extent that you were not forgiven a loan, and we'll talk about what that means in a minute, your payments on that loan will not be due until 6 months, until the 6-month period. So again, the worst case scenario on loan forgiveness is if you're not forgiven an amount of the loan, it becomes a 1% interest loan with payments deferred for 6 months and then due in 2 years. So not a bad consequence. I mean, better to have forgiveness, but if you don't get there, at least you got a pretty good loan. And again, I'll talk about some of the tax consequences of that in a minute. I lost my mouse. There we go. Okay. So as I said, I should have put the definitions before the timeline, but covered period is the 8-week period beginning on the date of the origination of the covered loan, or again, the beginning of the next payroll period with respect to payroll expenditures, by the way, only. The 8-week period for the other expenditures that I've listed down below does start with the date of the original loan. Covered rent obligations is something that will be a qualified expenditure for PPP forgiveness. And a question that came up with this was, what does that mean? Does that mean rent of real property, or does it mean, does it include the rent of personal property? I believe, and Kevin, you can correct me if I'm wrong, clarification came out that lease obligations, both for real property and personal property, do qualify as long as the payment was in for, or the contract was enforced before February 15, 2020. One of the things I see that I'm missing from my slide, and actually Frank had told me to add this and I forgot, is mortgage payments. So if you have a loan, and that loan was in place prior to February 15, 2020, a qualified expenditure in the 8-week period will be the interest payment on the mortgage, but not the principal. So again, we've got some exceptions to these, and you can see these rules are going to get complicated.
Tim, we do have a question that's pertinent to this.
Okay.
Mark Denholm asks, start of the 8-week period. Is that when funds are received or loan docs signed?
When the funds are received.
Okay, thank you.
And the good question, and the alternative date for measuring payroll related expenditures is the beginning of the next payroll period. So that's but good question. The other expenditure that had some controversy with it, again, I'm not sure resolved, is the utility payments. So payments for electricity, gas, water, transportation, telephone, or internet access. Again, if you were signed up for this particular service on or before February 15, 2020, or it might be before February, on or before. And some of the unknown questions were, well, what does transportation mean? Does that mean gasoline? Does it mean, rental cars? I don't know. Certainly public transportation was in existence. So we're going to need some more clarification on what transportation means. And then I heard an interesting comment the other day that cell phones did not count as telephone. Now, when I ran that by Kevin and his group, he said, I think that's wrong. I think cell phones would qualify. But there is it's a good example of, I think there's a lot of misinformation out there, and people, you know, throw things out and see what sticks kind of thing. So, but again, we're going to need probably more guidance on things like transportation and telephone to see if those in fact qualify.
And Tim, one other question on this. For example, if I own my company is a real estate investment company. So I have rental properties and residential fix and flip properties. Can I use utility expenses from those properties?
Well, so I think the general rule here is, if you were applied for a PPP as a trade or business, then clearly all of these activities will be qualified expenditures against the ones that are listed for purposes of the loan forgiveness. So yes, I would think that to the extent that it's utility, gas related to your trade or business. See, there's an interesting, again, more clarification I think needed. Is a real estate rental activity a trade or business for purposes of this? I think we're going to need a lot more guidance on this. You know, the definition from a tax standpoint of trade or business is not very well defined. It's developed of a lot of case law. So the whole body of knowledge regarding whether a real estate activity is a business activity is subject to debate. It really is in the tax law, and I think that's going to spill over into this. I mean, let me give you a good example. If all I do is I own a triple net property, okay, and again, we can define what a triple net is, but let's just say it's pure triple net. You're not paying any operating expenses at all. All you do is go to the mailbox, get a check, okay? Well, clearly, or I shouldn't say clearly, but certainly in the eyes of the IRS with respect to various aspects of the tax law, that is not a trade or business. It's not a trade or business. And if you were to have tried to apply for a PPP loan with respect to an entity that was the only activity, you probably would not have gotten the money, at least later on. Maybe in the beginning you would have, because I think that people weren't clear on the rules. In fact, I had a client who I'm embarrassed to say applied for and received an EIDL loan, got a $10,000 advance under the EIDL loan, and all he had in that entity was a piece of raw land that he had purchased on a speculative nature, and it was just sitting there. So he might be the one of those, you know, fits in that category of, you know, consult your attorney and or your spiritual advisor on whether he needs to put that money back. But so, you know, you phrased the question in a way that said, well, I have a mix of business. You know, I have a flip business, right, of rental property or construction. Okay, that's clearly a trade or business, because if you sell the property, it's going to be ordinary income. But if all you're doing is renting property, and if we're on the extreme case of a triple net, maybe not so much. And by the way, typically people who have triple net properties in their entities don't have pay wages. So, you know, you're not going to have a payroll, and you certainly wouldn't have earnings from self-employment. So it probably would have been next to impossible if you to get a PPP loan in the front end if you didn't have those. Okay, well, hopefully that answers the question. And maybe rolls into the primary driver, the primary cost. Let's just all put it on the table here, is that what Congress intended was that they wanted people to continue to work, okay? So that is why the focus is on payroll, okay? And the focus, as you will see, is also on making sure that people continue to work and continue to receive benefits, okay? Like family medical coverage, like group insurance premiums. And you can see I've got them listed here on this slide, retirement benefits, those type of things. So that's why it makes sense. Because if people are laid off, they're not only not getting a salary, but they're not getting medical coverage. They're not getting insurance coverage, those type of things. So this clearly was the intent of the law. And that is the driver. I think what a lot of people were confused about is, well, you know, what about these other benefits with respect to, say, you know, the employer is paying state and local taxes on compensation. That's an out-of-pocket expense. I should get that. Yes, absolutely. They said that. Well, what about the employer's portion of FICA, FUTA, you know, that type of thing? You know, I have to pay half of my employees' FICA and FUTA. Nope, sorry, that doesn't count. Well, what about the employee's portion of the FICA and FUTA? Well, yes, because that's included in your gross income. Okay, so I think in general, if you can just think in terms of, if I got the PPP money, I got it based on a payroll or my earnings from self-employment. We'll talk a little bit about that at the end. But primarily, if I was an employer and I have W-2 wages and I kept all of my employees and I didn't cut their salaries and I used the PPP money to continue that scenario, it is likely, although not 100% sure, I'll show you in a minute, that you will be 100% forgiven. Okay? So that's the extreme case. Now, that's not what everybody's going to do. And let's just go over a couple of things. I don't know if I want to get in the weeds here on the actual payroll cost. As I said, I showed you the general. I mean, think in terms of the payroll costs that allowed you to establish what your loan balance was with the bank when you applied, right? So you all that applied for your PPP had to fill out a form and had to add all those things that I just told you. So the general thought is that if you're going to spend that money on those things, you should be forgiven, okay? So again, it's compensation in excess of $100,000. If you're paying, you know, your officers more than $100,000, you know, in the 8-week period, just give an example, if I pay, you know, the president of the company who makes more than $100,000 a year, the first $15,000 I pay that officer within the 8-week period following the date that I received the loan proceeds, that'll qualify. But only up to $15,000. Now, where did I get the $15,000? I took the $100,000, divided it by 12, multiplied by 2.5, and that should be roughly the amount, right? So keep that in mind. Whatever you came in to get the loan proceeds, whatever you qualified for expenditures, that should qualify coming out for forgiveness, okay? Here's where I think a lot of the confusion, however, rests. And that is the ability to actually pay for things other than payroll costs. Now, you've probably, everybody that's on this call has probably attended more webinars than they want to on this issue. But you know, we've all heard about the 75%, 25%. So let me see if I can just explain this. If you take the loan proceeds and pay at least 75% of those proceeds go for the payroll costs that we just discussed, including the qualified benefits and nobody over $100,000 kind of thing, then you are allowed to spend 25% on the other identified expenditures. And I said in the other slide, payment of covered rent obligations, which could include leases of personal property, covered utility payments, transportation, gas, electricity, phone, and mortgage interest on that. If you spend those proceeds on anything other than those two categories, you're not going to be forgiven. That amount that you spent will roll into a 1% loan, payments deferred for 6 months, you know, and due in 2 years. Okay. It doesn't taint everything. It's not like, oh my God, I went over the threshold, now all my proceeds are back. No. It would be only those amounts that exceed these thresholds. So if you spent only 70%, right, on your payroll costs, then I believe, and this we're going to go through an example on this, there's going to be an adjustment to the amount that's going to be forgiven. We'll see how that works. Okay? All right. Again, I'm not going to really get into the weeds too much on this because we could suck up an awful lot of time, but understand that there are, so let me back up. So there's a multi-step process with respect to the loan forgiveness. The first one is, what did you spend the money on, right? So you're going to have these buckets where you're showing that the money was spent in the 8-week period on these categories of expenses. Now, once you prove that, you then have to go to a next step, which is to determine whether or not you maintained your workforce. Okay? So this is the second step. So I could spend 100% of my loan proceeds on payroll costs, but if my workforce declined during a particular measurement period, and just think in terms of your, whenever they give you choices, it makes it complicated. But you can see from this slide that you need to compare a period in time. For instance, let's take the first bullet point of the second paragraph. A period beginning February 15, 2019 and ending June 30, 2019. If you were then comparing your February 15, 2020 period to the June 30, 2020 period, and if during that period of time your full-time equivalency employees went down, you might be at risk for bumping into the limitation of forgiveness. We'll go over a question or an example in that in a minute. But I guess my point is, using the proceeds for 100% payroll gets you to the first step. Second step is to determine whether or not you decreased your workforce, okay, by a percentage, and I believe it's 25%. We'll see that in a second. And did you maintain the amount of your payroll? In other words, did you cut people's salaries? So you could have, in fact, maintained your employee count, head count, but actually decreased their salaries. So that's going to result in a reduction of your loan forgiveness if that condition exists. There's one more exception we're going to talk about. So this is the one I was referring to. So this is the limitation. The amount of the loan forgiveness shall be reduced by the amount of any reduction in total average annual salary or wages of an employee during the covered period that is in excess of 25%. So saying this another way, if I maintained my workforce, but I laid off 24%, okay, of my people, you're okay, right? If I cut their salary by 24% on average, you're okay. If you go over the 25% threshold, you have a problem. See, I'm going to go through an example here in a second, but before I do that, there is an exception to the limitation, right? So I'll give you an example. I have a client who called me up and said, this was a couple of weeks after March 16th, when this whole thing kind of blew up. How are you doing? He said, well, not too good. I just laid off all my employees. I said, Ken, why'd you do that? He said, well, because we're not an essential business. I had to shut everything down. I told him to go and collect unemployment. Have you applied for a PPP loan yet? no, actually, I haven't done that. Do I qualify? Yeah. Why don't you go talk to Kevin's group? Okay. Let's get them on board. And by the way, what you're going to have to do is before June 30th, if you want to be forgiven this loan, you have to hire all these people back, right? If you hire all the people back by June 30th, and in other words, so reestablish them and reestablish their wages, then the previous limitation that I just told you about will not apply. Okay, this is kind of a get out of jail free card. And again, the spirit of the law here, we want to put people back to work. We don't want them collecting unemployment, okay? We want them to continue with their salaries. Well, here's an interesting little unintended consequence, right? And you probably heard these stories. So I had a restaurant client who was actually a tenant of a client who applied for the PPP loan, but said, I've laid off all my employees, and you know what? They don't want to come back to work because they're making more on unemployment than they are that I was paying them, right? Everybody got a little $600 bump, you know, on the unemployment. So even if it
would it be possible to ask a quick question?
Sure, go ahead.
So specific to some of the topics you're covering at this moment, what kind of forgiveness could we be eligible for if, for example, some of the employees don't want to go back to full-time? So, for example, I rather than lay anybody off, there were a few employees that I just did reduced hours to, and then unemployment allowed them for a reduced hours unemployment compensation.
Right.
And so if they chose to stay in that manner, whereby they were still part-time employed, and then I hired on other people to make up their slack, so to speak, or their hours, so that, for example, I exceeded by 1 or 2 additional employees what I previously had, which is what I based my PPP loan numbers upon, and then so I'm still equal to or greater than the original aggregate, but yeah. I don't have everybody full-time employed. Is that eligible for forgiveness?
Yes. So I'm gonna have Kevin probably jump in on this because he probably is a little more knowledgeable than I am on this. But my understanding is you don't have to hire the same people back. All right. The head count must be the same in the aggregate, but it doesn't have to be the same people. And by the way, the little conundrum that I just mentioned about, and I have employees that don't want to come back to work because they're making more money, or maybe they just made a life decision. You know, hey, I was going to quit this gig anyway. I don't want to do this anymore. I don't want to come back. There was actually guidance that came out that said that if you can prove, document that you offered to have those employees come back and they voluntarily chose not to come back, or they were let go for something other than the COVID situation, they were actually terminated for cause, then you meet this rehire exception. Kevin, did I say anything wrong in that regard?
No, you got it. The thing I would say is that the FTE calculation is based on the number of hours worked. So if you have a part-time person and then you hire, a full-time person, then all that's going to get averaged out with the number of hours worked to determine the FTEs.
And I think they came out with guidance that the FTE is based on a 40-hour work week, not a 30-hour work week, right?
Correct. So you can either do it as, a percentage, or you can, if a person is more than, if they work 40 or more, then they count as one. If they work less than 40, they can be counted as a half to simplify your math. What we're doing for clients is calculating it both ways.
Yeah. Again, like I said, giving you choices makes things more complicated. And again, this is something that I hope you can see. You shouldn't be waiting till June 30th to calculate. Okay. I mean, you should at this point know whether or not your workforce has declined both in hours and in pay during a period. and you're going to use that period for the loan forgiveness. So that should be, you should be calculating that now. No reason to wait for that. So let's go through a simple example here, as simple as I can get it. Again, my thing is blocking the. You do these sessions and the little videos block the thing. I don't know how to make that go away. Anyway, so here's a typical loan, say $1 million. It could be 10,000. It could be 100,000. Probably more like 100,000. But the point is, in this particular situation, we're just going to say, you can say $1,000. Okay, but $1 million loan during the covered period. Right, again, the 8-week period beginning with the receipt of the funds, this particular client spent or incurred costs of $900,000. So understand that at that point in time, they have a $100,000 loan. Why? They didn't spend all the money. Okay? Now, let's keep in mind that if they didn't spend $100,000 of the $1 million loan, and they still have the $100,000 sitting in the bank, and they feel like they don't want a 2-year loan at 1%, give the money back. There is no prepayment penalty. Okay, if you don't want the loan, you can certainly give it back. Okay, but the point is, there is right off the bat, the first step. Only 900 of the million is going to qualify for forgiveness because that's all they spent. All right. Therefore, the 900 is eligible for forgiveness. That step is. And now the test is how much during the covered period, how many employees did you retain? Right. Well, in this particular example, the employer retained 90% of their workforce. There was 10% that was not retained, right? That 10% is going to be a loan, all right? Again, exception to this, if that retention was brought back up to its full amount by June 30th, then this whole 900 moves over into the forgiven column. But at this point, our assumption is that they were below that, okay? Then during the covered period, there was a salary reduction of greater than 25%. In this example, if that's the case, and that amount equated to $50,000, that reduces the loan forgiveness amount, that moves over into the loan column. And again, if this is restored by June 30th, then this moves over to this column. Okay, does everybody see that? But so I know from personal situation, both Kevin and my salaries have been cut by the firm. We experienced across the board cuts. Our managing partner has promised that those will be restored if economic conditions improve. Now, I think I heard him say, Kevin, that he was going to restore those August, right? We might want to encourage him to consider restoring those by June 30th. But anyway, that would be the case. So let's just say that we were going to restore those salaries by June 30th. All in this example would move over here to the loan forgiveness column. Okay. Let's take another example. Again, the same $1 million. We actually spent $1.2 million. Well, how can we spend more than what we got in the loan? Well, because we still have income or we still have some cash reserves. You know, money is fungible. But the point is, if you spend it on covered expenditures and you exceeded the $1 million, all of it potentially can be forgiven. All right. So we have eligible expenditures of $1 million. We retained 100% of our employees. We had Actually, I'm a little confused about my example here, because if we had covered period salary reduction of greater than 20, oh, I'm sorry, we did not have a salary reduction. That's what this is demonstrating. Again, this is Mario's slide here, so forgive me for I'm giving him full credit for it, because I thought it was a great illustration. But again, so 100% retention, no reduction in salaries, 100% loan forgiveness. Okay. Taking another step further, covered expenses, only 700. So right off the bat, 300 is going to move over to the loan column. We have 700 potential forgiveness. Here we have 70% dipping, dipping down to 70%. So that is moving over to the, that is moving over here to the loan column, right? 70% moves over here, 30% moves over here. And, but we maintain the salary levels. Okay, fine. But you can see from this $1 million loan or $1 million advance, 510,000 is going to be a loan. And then lastly, the big rehire thing, which I've hinted through all these examples, if these conditions exist and we rehire or restore wages, we get our full amount to the extent we paid the costs. Okay, I'm going to pause right there and ask if there's any questions. And we're getting, actually, Tim, we're getting pretty close to the end here, so I probably ought to. Well, let me just move along real quick and just get some of the highlights here. Documentation and cost tracking. So some best practices in this regard, as I said, do not wait until June 30th to start tracking some of this stuff. You need to be talking to your accountant now about a process by which you are going to do this, okay? There are some best practices regarding this. Maybe the use of a separate bank account to track the funds. Not required, by the way. This is not required. Again, money is fungible. So if I can put this money in my operating account, as long as I can show that I had qualified expenditures in an 8-week period, that's good enough. Now, I will say that I'm recommending this to clients who I know their bookkeeping is a mess, right? I mean, they send me their shoebox at the end of the year, and they don't have a clear way of telling me how they have spent money. I would like to see them put this in a separate bank account, have the check registered from that account. So that's a good practice, but not required. You don't have to show the bank you used that dollar and paid for that expense, but you do have to do the other tests that we talked about, okay? Like I said, don't wait. You ought to be able to, well, during this 8-week period, now that you started the clock, you should be projecting how much of this money you're going to be spending on the qualified costs during the covered period, right? You should have been doing these projections anyway. I know that as a CCIM group, not for profit, Terry and I happen to be the treasurer, go figure, of our local chapter. Terry and I sat down and said, all right, what does the next 6 months look like under this COVID? So you should be knowing where your costs are being spent, and that will help to say, all right, do I need the money? Am I going to give the money back? Am I going to use it for something other than payroll costs and convert this to a loan? So those calculations need to be made right now. Same thing with your full-time equivalencies. What periods are you going to measure against the covered period, and whether or not your wage amounts have fluctuated. So again, I'll make these slides available. You can see some of these considerations. I want to just talk real quickly about taxation, and then I'll open it up for questions. I was not surprised by the IRS's pronouncement in April that the loan proceeds, that expenditures paid with loan proceeds would not be deductible. It is actually logical and already baked into the code that if I make expenditures with tax exempt money, I can give you. I mean, here's the classic example. If you well, actually, when investment expenses were actually deductible, they're no longer deductible. But when they were deductible as itemized deductions, say you're paying your broker a commission to manage your stock portfolio or your investment portfolio. If your portfolio had in it tax exempt instruments, you're required by law to allocate that investment expense to tax-exempt income and taxable income, and you were only allowed a deduction to the extent that that fee was allocated to the taxable income. It's the same exact issue here, okay? Again, as I mentioned, money is fungible, so you can't directly say, well, I used this money to pay for that expenditure, although maybe it could help you in a tracing situation to avoid this particular issue. But the bottom line is, to the extent that you have both taxable income in 2020 and non-taxable income, i.e. loan forgiveness, I believe there's going to be a calculation that's going to have to be done to apply that percentage against all of your expenditures that were paid during, again, that covered period. And to the extent that that fraction is allocable to expenditures, you're not going to be able to get the deduction. So this is going to be an interesting calculation. I know that Treasury, or actually Congress, is debating this right now. They could very well come out with a rule that says, you know what, this is too complicated, we're going to allow it as a deduction. But right now, as it stands, not deductible. And let's not forget, state of California. State of California is not what we call a immediate conformity state with respect to federal taxation. So state, they have to basically adopt any changes that the feds make to the tax law. And at this point, they have been fairly silent on whether or not the actual forgiveness of the debt is taxable. Right? Congress did come out and say, we're going to forgive this debt. That's not going to be taxable. But in a sense, it's kind of taxable because they don't give you a deduction for the expenses that you used to pay for it. But California has said, hey, the forgiveness of the debt is not going to be non-taxable. So in that case, actually, the expenditures would be deductible, which might tip the scale toward, hey, might as well get a loan. Because if I let this all roll into a 1% loan and there is no forgiveness, that means 100% of the expenditures you paid are going to be deductible. So again, going to have to run the numbers. All right, Kevin, did I misspeak or anything? Did you want to say a couple of final things?
Well, we've got a lot of great questions through the chat, Tim.
Okay.
I could paraphrase and answer a few of those if you think we have time.
Let's do that.
Yeah, so the first question is about bonuses or increased pay during the covered period, the 8-week period. And there's some other things in there about the wife who's a non-owner employee and all that. The deal is that where they're going to get you is the maximum that Tim was talking about. So you can't pay anybody any more than the $15,385 for the 8-week period. So, your mileage is going to vary there as far as, how you do your payroll, but you just can't exceed that. Mm-hmm. The next question was around the EIDL advance. And yes, they're talking about most people got the 10,000, but they did give reduced amounts to certain people because they, based on the number of employees. So it was $1,000 per employee up to 10,000. But if you've got that, then yes, that's going to count against your forgiveness. If you've got an EIDL loan, the full loan, not the advance, and you got that after you've already got your PPP, then that becomes a working capital loan, and that's where they diverge, right? You can't spend the EIDL on payroll. If you've got your PPP, you're going to spend that on payroll, and your EIDL is going to be working capital. We did have some clients that were lucky enough to get both.
And by the way, the EIDL loan is not the 1% deferred for 6 months due in 2 years. It actually is I believe it's a fully functioning 30-year amortization loan at a 3% something, right?
It's 3.5, and it's up to the SBA. They're going to look at your particular situation and determine the period, but it is up to 30 years.
Okay.
The next one is, so if your loan is under $2 million, you don't need to submit for forgiveness. No. What Tim was saying is that they made a statement, the Treasury did, that if it's under $2 million, you're deemed to have a economic need or not access to other capital. So they're saying they're not necessarily going to audit you, right? You may get caught up in a random, but they're not like the over 2 million. They've stated that they're going to try and audit all of those, but under 2 million, no.
Right.
Another one here, submitted online application for $10,000 and received $1,000. I'm assuming we're talking about the EIDL there. And it says, how and when do I fill out forms for forgiveness? If it's actually the EIDL advance, you don't have to do anything. It's free money. There's no forgiveness required. If it's a PPP, then all the stuff we're talking about applies. But again, it's $1,000, so I'm thinking it's probably EIDL.
And if it was idle and PPP, then the idle will reduce the forgiveness on the PPP because you've already been forgiven on the idle. That's
Correct.
The link, right?
On the 8-week period, if funds received next payroll, not sure about that one, Mark Denholm.
If funds received 4/21, next payday 4/30 is the next payroll period 5/1. Yeah, I believe that is the intent. I think that was the intent. In other words, and again, be clear, this is only for payroll-related costs paid or incurred during the 8-week period. It doesn't have anything to do with rent or utilities or all that kind of stuff. So you're still going to have to track from April 21st all the other non-payroll-related costs. This only gives you a bump or an extension, if you will, for payroll-related costs.
Yeah, shift. You still only get 56 days. It just allows you to shift it to a period that administratively meets what you're doing for payroll.
Right.
The next one is interesting with real estate activity is the intent of the loan to support your operating business. Well, it's the intent of the loan is to protect paychecks or the equivalent thereof. So if you got the loan, however you got the loan and whatever business entity from that perspective, all the stuff that Tim's been talking about today applies. So replacement of income or the eligible expenses.
But I think the key here is that with self-employed individuals, they're talking about Schedule C. So you brokers in the room, you're used to reporting your commissions on a Schedule C unless you operate your business as an entity, say an S corporation. But if you're operating as a sole proprietor, your loan was determined based on your line, whatever it is, Kevin, 20, 21, or 31 of your schedule.
31.
31, prepared for 2019, by the way. So my understanding is self-employed individuals actually had to, even if they hadn't filed their 2019 return yet, had to complete a Schedule C for 2019 in draft form in order to be able to let the bank know what their projected self-employment income for 2019 was going to be. So, thinking in terms of a rental real estate investment, none of that goes on a Schedule C because you don't pay self-employment tax on rental income. So I think that's the way to look at it. If I'm a real estate broker, Schedule C income.
Correct. The next one is about cell phones and it being under the individual's name, not under the business entity. I think the way I read that is that in 2019, if you had that cell phone deduction, probably this is through a Schedule C. If you had that on your Schedule C and you did it that way previously, right. If you're working with me, I'm going to suggest you allow that. Yeah. Something about the PPP refinancing. I think the PPP and the EIDL, they diverge after if you get them separately. I think what you might be referring to is that in the beginning, if you had an EIDL loan, then you, on the application that came out after April 3rd, you would add the EIDL amount to your PPP and in essence refinance it. But if you got the EIDL after the PPP, then it's just a working capital loan that follows that track. But again, it's about the purpose. Did you need it for payroll? Right. Next one, Kaiser premium. Yes, that counts towards your insurance benefits. To anyone who's interested, yeah. And then there's someone saying that there's clear funding. There are still lenders out there. We have connections with banks that are doing that as well. The sole proprietor, real estate agent, how would the calculations work for debt forgiveness? Yeah, they actually made at least that part pretty simple. So if you're on a Schedule C and you're basically going to get 2 months of what they consider to be compensation replacement. So you take line 31 and you divide it by 12 and then, multiply it by 2 and that's 2 months and that's going to be your forgiveness. So there's not a whole lot of work to do in that case. Hey, Tim, I can't hear you. Did you say something? I think Tim's on mute.
I'm sorry. My boss just called. John just called me. I don't know, but he didn't see my calendar. Anyway.
Okay.
All right.
The next one is 50% managing member of an LLC with no employees. My understanding is the 8 weeks of all the LLC's managing members pass-through incomes are forgivable. Well,
Shane, that might be one that you and I can talk about offline.
Yeah.
Why don't we do that?
Yeah, I think there's a little.
That'll need some more consideration, but I'm happy to talk to you offline about that.
Thanks.
Yep. Can I consider my property manager as my employees for PPP or EIDL?
Yes, if you give them a W-2.
Yeah, that's pretty much it.
Right. No.
For self-employed without payroll. Oh, yes. For self-employed without payroll, can I simply make one payment to myself? That's getting back to what I was saying earlier about the Schedule C, line 31. It's just calculated. You don't need to pay yourself anything. If you got a loan based on that Schedule C, your forgiveness is just a function of the equivalent of 2 months of compensation coverage based on line 31. So you don't actually have to cut yourself a check or anything. You just have to apply using that Schedule C as your support.
Right.
And then we got 2 months versus 2.5 months. Yeah, that's a fun little thing they did, right? So the loan amount's based on 2.5 months, but the forgiveness period and all the calculations are based on 8 weeks. And this kind of goes back to what Tim was saying. You could do everything right here, following the rules, and still have some overhang, simply because of the way they've done the math. But you'll get pretty close if you follow the rules. Can I still apply for PPP or EIDL? EIDL is closed. They had it open a second time, but it was for agriculture only. But I think that's now even closed. And again, PPP is still available, and people are getting funded even this week. I think we
Yep.
worked through all of those, Tim.
Yeah, I think we did. Good job, Kevin. Oh, well, we're like way over, but I appreciate everybody hanging out, and it looks like we didn't lose a lot of participants. Do you want to wrap this up, Tim?
Yeah, I do want to wrap it up. Before I do that, I actually just have one question for you. Yesterday, I had heard some folks that I talked to about potentially the forgiveness amount, the 75%, even the timing could change. Have you heard anything of that sense? And if so, how would that affect the forgiveness, if at all?
So there, I did hear talk that the June 30 date might get pushed. Again, it just seems like this whole world is about kicking it down the road, and people just don't have enough time. I think the concern here is, do I have enough time to spend the money in the covered period on the right things such that I can give forgiveness? As you saw in the earlier examples, if I run up to June 30th and I haven't spent all the money, I got a loan or I got to give the money back. And so they're talking about extending that date. Kevin, is there anything update on that?
Yeah, I actually submitted a question to the SBA on that very topic because we got people that are getting loans so late in the process. Right. Is that 6/30 date a real stopping point? And the answer from them was, no, we don't think so. That's not the intent. You're going to get your 8 weeks, even if you get your loan on June 30th, right? Oh. They're still going to give you 8 weeks, but that's not what the rules say. No. So, until they do, we're advising everyone to proceed with caution and obviously get as much in to that before June 30th as possible. And listen, but I highly expect they're going to come out with clarification very soon on that matter, because
that would also extend to the rehire, right? The rehire exception. So if they push out
the same point, right?
Same thing, right?
Yeah.
Right. Good question.
The one thing I would add to all of this is that in Tim's planning is forecasting is really important for all these reasons, right? So if you just got your loan, knowing how you should spend it and where you're going to end up at the end, the more you can kind of forecast that as you go along, the better off you're going to be, and you're going to have fewer surprises. And again, it's just, and how difficult that is really depends on how complicated your situation is, the number of employees, and the fluctuations that you've seen.
Okay. Well, I want to say thank you to Tim Tikalsky and Kevin Shives. You both have been very, very wonderful, and thank you for the timely information. And to all the audience who logged in, I hope you find this information useful, and hopefully you can take it to apply it to yourself or to your clients. I think that's all the questions we have now. So thank you everyone for chiming in, and have a good rest of the day.
All right, and I'll be sure to, I'm going to get that link to Kevin's group. I'm going to send that to Terry. And so if anybody has any questions, feel free to click on that link and send Kevin and his group an email. And like I said, they'll get back to you within 24 hours.
All right.
Perfect.
Thank you.
All right.
Thank you, guys.
All right. Thank you.
See you.
Thanks, everyone. Thanks, Kevin.